Hey, welcome to Free Tax Tips. I got a new one for you today, and we're going to talk about what you can write off for the new homeowner. I just purchased a house. What can I take as a deduction? Well, really, there's about 3 or 4 things that are going to pop up as the primary things that you can take as a deduction. Number 1 is going to be the mortgage interest that you pay on the property. Number 2 is going to be the points, if you paid any points on your loan that you can take as a deduction on your income tax. Your real estate taxes, as well as the mortgage insurance premium. Now, let's look first at the mortgage interest deduction, because that's the biggest deduction that you're going to be able to take. I live in Los Angeles, so if my mortgage payment is, let's say, $3,000 a month, then about 90% of that, let's do simple math, $2,500 of my $3,000 is going to be probably paid in mortgage interest. Just mortgage interest of my $3,000 a month payment. Now, a $2,000 a month payment, about $1,800. Let's go back to the previous example, for instance. $2,500, you multiply that times 12, we're looking at a $30,000 annual mortgage interest deduction. Make sense? Then we had, if we did any points that we paid during our loan, then that mortgage interest, those points that you paid to acquire the loan are going to be deductible. And then the real estate taxes. Now, real estate taxes are assessed twice a year, and that bill you can pay all at once, or most people do wait and split it, have it part of the escrow payments, different options, but just keep in mind whatever you pay in real estate taxes for the year is deductible. Last but not least is the mortgage insurance premium. Mortgage insurance premium, this is how it works. If you pay less than 20% down, let's take a property, it costs $500,000. If you put 20% down, $100,000, that loan's going to be $400,000. You won't have any mortgage insurance premium. But if you put less than 20% down, let's say you only got $50,000, you put you put 10% down, then the loan's going to be $450,000. You're going to have mortgage insurance premium because it's less than 20%. Now, that's an additional deduction, but to avoid that, you had to come up with the additional 10% down. So, if you have less than the 20%, it's a good way to avoid paying the mortgage insurance premium because it lowers your monthly payment. But if you don't have it, don't let that stop you from buying a property and getting a tax deduction, because you can still benefit. Hope that makes sense. Also, what we want to talk about in our next video is what you can take as far as a deduction as for fix-up, that is, because a lot of times people think that if they do repairs to their personal residence that they can take those as deductions. Not so. That's for rental properties, which we'll cover next time. Now, if you like this video, you found it helpful, feel free to like us. You can also subscribe to our channel, and we'll catch you next time.